Have you ever felt the immense weight of a single financial decision? It's a feeling that can keep you awake at night, a silent pressure that just builds in the quiet moments of your day. You stare at the numbers on a screen, the charts that rise and fall like a volatile heartbeat, and you wonder if you're making the right move. This isn't just about money, it's about the future you're trying to build, the security you hope to provide, and the freedom you dream of. Every choice feels monumental because, in many ways, it truly is. The path to financial independence is paved with these moments of uncertainty, and how we navigate them defines everything. I remember a story about a man named Arthur. He wasn't a Wall Street wizard or a tech billionaire. He was a quiet, diligent librarian who spent his life surrounded by books, not stock tickers. For decades, he methodically saved a small portion of his modest salary. His colleagues saw him as frugal, maybe even a little eccentric. They didn't see the late nights he spent not watching television, but reading annual reports and studying the long-term history of the market. They didn't understand the discipline behind his simple, unchanging strategy. He wasn't chasing quick wins or thrilling trades. He was playing a different game entirely, a game that almost no one around him even knew existed. Arthur's story isn't about a lucky stock pick. It's about a profound understanding of something most investors miss. We are often taught the mechanics of investing, how to buy a stock, what an ETF is, the definition of diversification. We learn about PE ratios and market caps. But we are rarely, if ever, taught about the most powerful force that dictates our financial success or failure. It isn't the market, the economy, or the assets we choose. It's the intricate, often invisible architecture of our own minds. It is our psychology that ultimately steers the ship. This is the lesson that changes everything, yet it remains hidden in plain sight, absent from financial textbooks and classroom lectures. It's the reason two people with the same income and access to the same information can end up with drastically different financial outcomes. One builds lasting wealth, while the other struggles with a cycle of fear and greed. The difference lies not in their intelligence or their resources, but in their investing psychology. Understanding this single principle is the key to unlocking a level of financial control and peace of mind you may have never thought possible. What if I told you that the most important financial skill has nothing to do with finance? It has everything to do with understanding your own behavior. Think about it. We spend so much time analyzing external factors, the next hot stock, the direction of interest rates, the whispers of a coming recession. We treat investing as an external game played on a field of numbers and charts. We look for answers out there, believing that if we could just find the right secret, the perfect formula, we would unlock the gates to wealth. This relentless search for external solutions is often what leads us astray from our long-term goals. The truth is, successful investing is an internal game first and an external one second. It's a battle fought not on the trading floor, but in the space between your ears. It's about mastering your impulses, managing your emotions, and aligning your actions with your long-term intentions, especially when it feels hardest to do so. The greatest risks to your portfolio aren't market crashes or economic downturns. They are the behavioral traps hardwired into our human nature. Panic selling, chasing trends, overconfidence, and the paralyzing fear of missing out. These are the unseen architects of financial ruin. So, the lesson we were never taught is this. Your relationship with money and risk is a reflection of your relationship with yourself. Are you patient or impulsive? Do you seek validation from the crowd or trust your own diligent research? Can you remain calm when everyone else is panicking? These aren't just personality questions, they are the most critical diagnostic tools for your financial health. Building wealth isn't about outsmarting the market, it's about outsmarting the self-defeating instincts that sabotage our best-laid plans for achieving financial literacy and security. In this journey together, we're going to pull back the curtain on this hidden dynamic. We will explore the psychological forces that shape every decision you make with your money. This isn't about tips or tricks. It's about a fundamental shift in perspective. It's about building a mindset so resilient, so disciplined, that it becomes your greatest asset. More valuable than any stock, bond, or piece of real estate you will ever own. By the end of this video, you'll uncover 17 investing psychology lessons no one taught you. The same lessons that quietly separate the wealthy from the rest. You'll learn how to avoid the most common money traps and move strategically toward true financial independence. So, hit that subscribe button and let's dive in. Imagine for a moment that you have two distinct investors living inside your head. The first is your analytical brain. This is the part of you that loves spreadsheets, pores over data, and diligently builds a logical case for every investment. It understands the power of compounding, the importance of diversification, and the mathematical purity of a long-term strategy. This brain is rational, patient, and operates on the facts. It's the version of you that reads financial reports, calculates future returns, and creates a well-thought-out plan designed to achieve financial independence over decades. It is the architect of your financial future, drawing the blueprints with precision and care. Then, there is the second investor, your primal brain. This part of you is ancient, hardwired for survival, and operates almost entirely on emotion. It doesn't care about your 10-year plan or the elegant logic of your asset allocation. Its primary concerns are immediate threats and immediate rewards. It's the brain that feels a jolt of panic when the market drops 5% in a single day, screaming at you to sell everything before you lose it all. It's also the brain that feels an intoxicating rush of FOMO, fear of missing out, when it hears stories of people getting rich quick on a speculative asset, urging you to jump in before the opportunity is gone forever. The central conflict in every investor's journey is the constant battle between these two brains. Your analytical brain knows that market downturns are a normal, healthy part of the long-term cycle and often represent a great buying opportunity. But your primal brain interprets that same downturn as a mortal danger, like a predator lurking in the shadows, triggering a fight-or-flight response. This internal tug-of-war is the hidden force that derails more financial plans than any economic recession or corporate bankruptcy ever could. The real challenge of wealth building is not finding the right investment, it's learning how to let your analytical brain stay in the driver's seat. This is why investing psychology is so critical. It's the practice of recognizing which brain is speaking and why. It's about creating systems and rules that protect your long-term plans from the short-term emotional whims of your primal instincts. Without this awareness, you are essentially bringing a knife to a gunfight. You can have the most brilliant financial strategy in the world, but if you haven't prepared for the psychological warfare that your own mind will wage against it, that strategy will likely crumble at the first sign of real pressure. True financial literacy involves understanding both the market and yourself. One of the most powerful psychological biases we face as investors is called hyperbolic discounting. It sounds complex, but the idea is simple and profoundly human. We have an overwhelming preference for smaller, immediate rewards over larger, delayed rewards. Our primal brain is wired to value the certainty of now far more than the abstract possibility of later. It's the reason why choosing to save an extra $100 for a retirement that is 30 years away feels so much harder than spending that same $100 on a nice dinner tonight. The dinner is tangible, immediate, and certain. The comfortable retirement is distant and theoretical. This cognitive trap creates a powerful gravity of now that constantly pulls our attention and resources toward the present moment, making long-term strategy incredibly difficult to execute. It's the hidden force that whispers, you can start saving more next year, or just this one time. It's okay to dip into your investment account. It systematically sabotages our compounding efforts by prioritizing short-term gratification. Every decision to delay saving, to sell during a panic, or to chase a hot trend is a victory for the primal brain and its obsession with the immediate. It's a force working against your wealth every single day. Think of it like trying to launch a rocket into orbit. To escape Earth's gravitational pull, the rocket needs an immense sustained burst of energy. Your long-term financial plan is that rocket. The gravity of now is the relentless force pulling it back down to Earth. The small, impulsive decisions, the daily temptations to spend rather than invest, to react rather than wait, are like tiny leaks in the fuel tank. Individually, they seem harmless, but collectively, they can drain your momentum, ensuring your financial goals never achieve the escape velocity required for true, lasting wealth and financial independence. Overcoming this requires more than just willpower. It requires building intentional systems. This is where the practical application of investing psychology comes into play. It means making your good habits automatic and your bad habits difficult. Setting up automatic transfers to your investment accounts, for example, bypasses the daily decision-making process. It puts your analytical brain's plan on autopilot, making it immune to the momentary whims of your primal brain. You are consciously designing a system that works with your psychology, not against it, building a firewall between your emotions and your asset allocation. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. He supposedly said, "He who understands it earns it, he who doesn't pays it." Now, while the quote's origin is debated, its wisdom is honestly undeniable. Compounding is the engine of wealth creation. It's the process where your investment returns actually begin to generate their own returns, creating this sort of chain reaction of growth that, over time, can transform a small, consistent contribution into a fortune. On a spreadsheet, this concept is, well, beautiful and logical. It's a perfect upward curve, a testament to the power of patience and discipline. It is the core mathematical principle behind every successful long-term strategy. But here's the critical disconnect. Compounding isn't just a mathematical principle, it's a psychological one. The real challenge isn't understanding the math, it's developing the mindset to let the math work its magic. Most investors intellectually grasp the concept, but they fail to embody the patience it demands. They interrupt the process. The primal brain, with its craving for immediate action and results, finds the early years of compounding painfully slow and honestly kind of boring. It sees the small, incremental gains and dismisses them as insignificant, failing to appreciate the powerful foundation being built beneath the surface. True wealth is often built in silence, far from the noise of the daily market. Adopting a compounding mindset means fundamentally shifting your perception of time. It requires you to find satisfaction not in the daily fluctuations of your portfolio, but in the simple, repeated act of contributing to it. It's learning to celebrate the process, not just the outcome. This is where so many people falter. They plant the seed, but keep digging it up to see if it's growing, disrupting the very process they hope to benefit from. This impatience is really the enemy of compounding. It leads to chasing short-term gains, jumping in and out of the market, and constantly tinkering with a perfectly sound asset allocation, thereby resetting the clock on your growth. Therefore, the first step to harnessing this incredible force is an internal one. You must make peace with the idea of being bored. You must learn to equate consistency with excitement and patience with power. The compounding mindset doesn't look for fireworks. It finds its strength in the steady, rhythmic drip of water that eventually carves a canyon through rock. It's a quiet confidence that your disciplined actions today are laying the groundwork for an unstoppable financial momentum tomorrow. This psychological shift is the true key to unlocking the eighth wonder of the world in your own financial life. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. All right, let's talk about the slow path to unstoppable momentum. Think about how you build momentum in any other area of life. When you start a new fitness routine, the first few weeks are honestly the hardest. The progress is barely visible, your muscles ache, and the motivation to quit is, well, incredibly high. You don't see a dramatic transformation overnight. However, if you stick with it, something magical happens. The workouts get a little easier. You feel a little stronger. The small, consistent efforts begin to build on each other, creating a positive feedback loop. After a few months, you have built momentum. It actually becomes harder to stop than it was to start. This is the exact same dynamic at play with your investments. The initial phase of your wealth-building journey is the slow path. This is where your contributions do most of the heavy lifting. Your investment returns are small because your principal is still relatively modest. It can feel like you are just pouring water into a vast desert. This is the period of maximum psychological friction, where your primal brain is most likely to question the entire strategy. It will scream that it's not working fast enough and that there must be a quicker way. Resisting this voice is the single most important battle you will fight on your path to financial independence. It is the ultimate test of your investing psychology. The compounding mindset is what carries you through this slow path. It's the deep-seated belief that your consistent actions are building a critical mass, even when the results aren't yet visible. It's the faith in the process itself. Then, an inflection point is reached. This is the moment when the returns your money is generating start to become larger than the contributions you are making. Your wealth starts to build its own unstoppable momentum. The snowball you started at the top of the hill is now an avalanche of growth, and it's working for you day and night, whether you are paying attention or not. This is the reward for your patience. It's the payoff for enduring the initial boredom and resisting the temptation to constantly change course. By protecting your strategy from your own emotional interference, you allow your assets to reach a state of escape velocity. You transition from actively pushing the boulder to letting gravity and momentum take over completely. This is the ultimate goal of a long-term investor, to build a portfolio so robust and self-sufficient that it works harder for you than you ever had to work for it. It's the slow, deliberate path to true financial freedom. Your financial strategy is the architect of your future wealth. It's the carefully crafted blueprint, drawn with logic and foresight by your analytical brain. This plan accounts for your goals, your time horizon, and your tolerance for risk. It dictates your asset allocation, your savings rate, and your rebalancing schedule. It is a masterpiece of intention, designed to construct a sturdy and resilient financial structure over many decades. The architect works with rulers, calculators, and long-term projections, building something meant to withstand the inevitable storms of market volatility. Its work is slow, methodical, deliberate, and fundamentally optimistic about the power of a disciplined process. Your emotions, however, are the wrecking ball. They operate without a plan, driven by the primal, short-sighted impulses of fear and greed. A sudden market plunge unleashes the wrecking ball of panic, swinging wildly with the urge to sell everything now, before more damage is done. A story about a friend making a fortune on a speculative bet unleashes the wrecking ball of envy, tempting you to abandon your sound architectural plan and chase after the thrill of a quick win. These emotional forces don't care about your long-term blueprint. They only care about reacting to the immediate noise, and their power can demolish years of patient construction in a matter of hours. This is the central conflict that every investor must manage: the architect's meticulous plan versus the wrecking ball's chaotic force. A strategy is only as strong as your ability to protect it from your own emotional reactions. You can have the most brilliant asset allocation model in the world, but it is utterly useless if, at the first sign of trouble, you allow the wrecking ball of fear to smash it to pieces. This is why investing psychology is not a soft skill. It is the most crucial defensive mechanism in your entire financial arsenal. It is the steel reinforcement that protects the architect's vision from your own potential for self-sabotage. The goal, then, is not to eliminate emotion. That is impossible, as we are all human. The goal is to build a system where your strategy governs your actions, not your feelings. It's about recognizing when the wrecking ball is starting to swing and having pre-established rules in place that prevent it from making contact with your portfolio. It means creating a clear separation between feeling and emotion, like panic or euphoria, and acting on that emotion. True financial discipline is found in that space, where you acknowledge the feeling but choose to adhere to the architect's logical and predetermined plan for long-term wealth. How, then, do we practically build defenses against the wrecking ball of emotion? How do we ensure the architect's plan is followed, even when our primal brain is screaming for us to do the opposite? The most powerful tool at our disposal is automation. Automation is the practical antidote to emotional decision-making. It is the system you design during your calm, rational moments that runs on its own during your inevitable emotional, irrational moments. It is the ultimate expression of your analytical brain, creating a process that protects your future self from your present self's impulses. It is the foundation of a sound, behavior-proof, long-term strategy. Think about the simple, profound power of an automatic investment plan. By setting up a recurring transfer from your bank account to your investment account every single payday, you remove the element of choice. You are no longer asking yourself each month, should I invest now or wait? Does the market look too high? Maybe I should just spend it this time? The decision has already been made. The system executes your plan flawlessly without being influenced by scary headlines or tempting market chatter. This simple act of automation single-handedly defeats the two biggest behavioral risks, market timing, and the temptation to stop investing during downturns. This strategy, often called dollar-cost averaging, is psychologically brilliant because it transforms volatility from your enemy into your ally. When the market is down, your automated investment buys more shares for the same amount of money. When the market is up, it buys fewer. You are systematically buying low without ever having to feel brave enough to do it. You have outsourced the emotionally difficult task of investing during a panic to an unfeeling algorithm that simply follows your pre-written instructions. This removes the wrecking ball's power source, your need to make an active decision under duress. Ultimately, automation is an act of humility. It is the acknowledgement that our willpower is finite and that our emotions are powerful. Rather than relying on being perfectly disciplined at all times, an impossible standard, we design a system that makes discipline the default setting. It is the most effective way to align your actions with your long-term intentions, creating a fortress around your wealth-building plan. By making your investing automatic, you are freeing up your mental and emotional energy to focus on what truly matters. Confident that the architect's plan is being executed day in and day out, building your financial future brick by brick. In the world of finance, patience is often misunderstood. We tend to see it as a passive act of waiting, a form of inaction. But in the context of investing psychology, true patience is an active, strategic, and often difficult discipline. It is not merely the ability to wait. It is the ability to maintain your conviction and stick to your well-researched plan while everything around you seems to be in a state of chaotic flux. Patience is the conscious decision to prioritize the long-term signal of your strategy over the short-term noise of the market. It is a form of courage, the strength to do nothing, when your primal instincts are screaming at you to do something. This active patience pays a quantifiable reward, what we can call the patience premium. This premium is the excess return you earn over investors who are constantly reacting to market news, chasing hot stocks, or panic selling during downturns. Every time you refrain from selling in a crash, you are earning that premium. Every time you stick to your automated investment plan instead of trying to time the bottom, you are earning that premium. It is the financial compensation for winning the internal battle between your analytical brain and your primal brain. It's a dividend paid not by a company, but by your own disciplined behavior. Think of the market as a wild, untamed horse. The impatient investor tries to jump on and off constantly, predicting its every move, and is inevitably thrown off, bruised, and defeated. The patient investor, however, doesn't try to tame the horse. Instead, they build a strong, secure enclosure, their financial plan, and simply let the horse run within it. They understand that over the long term, the horse's general direction is forward, and their job is not to micromanage its every step, but to ensure the enclosure remains intact. This approach requires immense trust in the process and the fortitude to ignore the dramatic sprints and stumbles along the way. This is why the greatest fortunes are often built not by the most brilliant traders, but by the most steadfast holders. Their genius lies not in predicting the future, but in their unwavering refusal to be shaken from their long-term strategy by present-day fear or euphoria. They understand that wealth isn't created in moments of frantic activity, but in the long, quiet, and often boring stretches of inactivity. The patience premium is the market's reward for your emotional resilience, a direct result of choosing your long-term financial independence over short-term emotional relief. As an individual investor, you have one significant structural advantage over most professional fund managers and financial institutions. It's not access to better information or a higher intellect, it is your time horizon. This is your secret weapon, a concept known as time arbitrage. Professionals are often judged on their quarterly or even monthly performance. They are under immense pressure to generate immediate results, which forces them into a short-term game. This pressure often leads them to sell assets at inopportune times or chase fleeting trends, all to satisfy the impatient demands of their clients or bosses. They cannot afford to look patient. You, on the other hand, are accountable only to your future self. You can set a time horizon of 10, 20, or even 30 years. This freedom allows you to exploit the market's obsession with the now. You can buy excellent assets when they are temporarily out of favor because of short-term bad news, knowing you have the years required for their true value to recover and flourish. You can calmly ride out entire bear markets, unconcerned by the quarterly reports, because your finish line is decades away. Time arbitrage is the practice of using your long-term perspective as a strategic advantage over a market full of players forced to think short-term. This advantage, however, is only valuable if you have the psychological fortitude to use it. Many individual investors possess a long time horizon on paper, but adopt the short-term mindset of a day trader in practice. They check their portfolios daily, agonize over every percentage point drop, and get swept up in the same news cycles that trap the professionals. They willingly give away their single greatest edge. To truly leverage time arbitrage, you must fully embrace the compounding mindset and internalize the fact that the day-to-day movements of the market are largely irrelevant to your ultimate success. Therefore, cultivating patience is how you activate your time arbitrage advantage. It means consciously choosing to play a different game than the majority of market participants. While they are sprinting in a chaotic race for the next quarter's returns, you are on a steady, determined marathon toward lifelong financial security. You let them react to the noise while you focus on the signal. By combining a long time horizon with the emotional discipline to stick with it, you unlock a powerful source of alpha that is unavailable to those who are slaves to the present moment. This is how you turn your patience into pure, tangible profit. We typically think of asset allocation as a purely financial exercise, a technical task of mixing stocks, bonds, and other assets into a portfolio that balances risk and reward. We're taught to consider objective factors like our age, income, and time horizon. While these elements are undeniably important, they only tell half the story. The most crucial factor in designing an asset allocation that you can actually stick with is something far more personal, a deep and honest understanding of your own temperament. Your asset allocation is not just a financial strategy, it's a mirror reflecting your psychological makeup, your tolerance for uncertainty, and your emotional triggers. A portfolio that is perfect on a spreadsheet but misaligned with your personality is, well, destined to fail. For example, if you're someone who loses sleep over market volatility, a portfolio with 90% in aggressive growth stocks is a ticking time bomb. The first significant downturn will trigger your primal brain, and the immense psychological pressure will likely cause you to abandon the strategy at the worst possible moment. Conversely, if you have a high tolerance for risk and a very long time horizon, an overly conservative portfolio might lead you to feel frustrated and tempted to make impulsive, speculative bets to chase higher returns. The goal is to find the perfect intersection of math and mind. Therefore, the process of determining your asset allocation must begin with introspection. It requires asking difficult questions that go beyond the numbers. How did you feel during the last major market crash? Do you feel a stronger pull from the fear of losing money or the fear of missing out on gains? Are you able to ignore your portfolio for weeks or months at a time? Or do you feel a compulsive need to check it daily? The honest answers to these questions are the most valuable data points you have. They provide the essential psychological parameters within which your financial plan must be built if it is to survive contact with reality. This is what it means to say asset allocation is self-knowledge. It's the frank acknowledgement that the best portfolio is not a universal formula, but a deeply personalized one. It's the one that you have the highest probability of adhering to through thick and thin for decades on end. It's a strategy designed not just for your financial goals, but for your emotional wiring. Building this kind of portfolio requires a level of self-awareness that's rarely discussed in finance, yet it is the absolute bedrock of a successful long-term investing journey and the core of true financial literacy. Once you have a clear picture of your psychological profile, you can begin to use asset allocation as a tool to build behavioral guardrails. These guardrails are the structural features of your portfolio designed specifically to protect you from your own worst instincts. They're the pre-commitments you make in moments of clarity that constrain your ability to make damaging, emotional decisions in moments of chaos. This is the practical application of turning self-knowledge into a resilient and robust long-term strategy, ensuring your architect brain remains in control. It's about designing a portfolio that anticipates your emotional weak spots and builds defenses against them. For the investor who is highly risk-averse and prone to panic selling, the guardrail might be a larger allocation to high-quality bonds than a standard model would suggest. While this may slightly lower the potential long-term return on paper, its real value is behavioral. That stable bond allocation acts as a psychological anchor during a stock market storm, reducing the overall volatility of the portfolio. Seeing a smaller overall drop might be the very thing that gives you the fortitude to stay invested and not sell your stocks at the bottom, thereby saving you from a catastrophic mistake that would dwarf the slightly lower returns. For the investor prone to overconfidence or chasing speculative fads, a guardrail might be a written rule that allocates a very small fixed percentage, say 1 to 5%, of their portfolio to play money. This small sandbox gives their primal brain an outlet for its speculative desires, without putting the core, long-term portion of the portfolio at risk. By intentionally creating a small, contained space for high-risk bets, you prevent that impulsive energy from spilling over and corrupting the disciplined, boring strategy that is responsible for building the vast majority of your wealth and ensuring your financial independence. Ultimately, these guardrails are an admission of our own humanity. They're a humble and intelligent way to manage the inescapable conflict between our emotions and our long-term goals. Your asset allocation becomes more than just a mix of assets. It becomes your personalized defense system. It's the thoughtfully constructed fortress, with walls and moats placed exactly where you know you are most vulnerable to attack from your own internal enemies. This proactive, psychologically informed approach to portfolio construction is one of the most sophisticated and effective techniques for ensuring your wealth-building journey stays on course for life. Human beings are social creatures, wired for connection and belonging. For millennia, our survival depended on our ability to stick with the tribe. Following the group, doing what everyone else was doing, was a life-saving instinct. This deep-seated psychological impulse, known as the herd mentality, remains incredibly powerful today, and nowhere is its influence more dangerous than in the world of investing. The market is a giant, global herd. When it stampedes in one direction, driven by either widespread euphoria or collective panic, the magnetic pull to run with it can feel almost irresistible. This is the siren song of the crowd, a beautiful and alluring melody that often leads investors straight into the rocks of financial ruin. This instinct manifests in two primary ways. The first is the fear of missing out, or FOMO. When a particular stock, cryptocurrency, or asset class is soaring, and stories of overnight millionaires fill the headlines, our primal brain feels an intense anxiety about being left behind. We see the herd feasting and feel a desperate urge to join in, often abandoning our own sound, long-term strategy in the process. We jump in near the peak, just as the early, smart money is quietly cashing out. The second manifestation is the panic selling during a crash. When everyone around us is selling, our instinct screams that they must know something we don't, and that staying put means certain doom. The danger of the herd is that its decisions are rarely based on logic or fundamental value. The crowd operates on pure emotion and social proof. An asset's price goes up simply because other people are buying it, which encourages even more people to buy, creating a self-reinforcing feedback loop or bubble. The same is true on the way down. Fear feeds on itself, creating a cascade of selling that has little to do with the underlying health of the businesses being sold. Following the herd means you are outsourcing your decision-making to the most emotional, irrational, and short-sighted parts of the collective human psyche. It's the exact opposite of a disciplined, long-term strategy. True independent thinking in investing is therefore an act of rebellion. It's the conscious decision to unplug from the emotional currents of the crowd and rely instead on your own research, your own plan, and your own principles. It requires the psychological strength to stand still while the herd stampedes around you, or to walk in the opposite direction entirely. This is an incredibly lonely and difficult path to take, as it goes against every social instinct hardwired into our brains. But it is the only path that leads to superior, long-term results. The greatest opportunities are often found in the places the herd has abandoned. The antidote to the siren song of the crowd is not to be contrarian for the sake of being different. The goal isn't to blindly bet against the herd at every turn. Rather, the antidote is to have the courage to be boring. A successful long-term investing strategy, when executed correctly, is profoundly unexciting. It involves buying broad market index funds, holding them for decades, and rebalancing periodically. There is no thrilling story to tell at a dinner party. There are no dramatic wins or losses to recount. It is the slow, methodical, and predictable path of the compounding mindset, a path that the herd, with its craving for novelty and action, finds utterly unappealing. This boring strategy is psychologically difficult because it offers no immediate gratification or social validation. When your friends are excitedly discussing their big gains on the latest hot tech stock, telling them you simply bought more of your global index fund feels, well, pretty dull. This is where your conviction is really tested. Independent thinking isn't just about making the right analytical choice. It's about having the emotional resilience to stick with that choice, even when it feels socially isolating. It's the quiet confidence that your unexciting plan is mathematically and historically superior to the herd's frantic chase for the next big thing. True wealth is most often built in silence and solitude. Building this courage requires a fundamental shift in where you derive your sense of accomplishment. You must learn to get your satisfaction from the process, not the outcome. Your win for the day isn't seeing your portfolio jump by 3%. Your win is successfully executing your automated investment plan. Your win is ignoring the panic-inducing headlines. Your win is calmly rebalancing your portfolio according to the rules you set for yourself a year ago. By redefining success as adherence to your boring but effective plan, you insulate yourself from the emotional highs and lows of the market and the social pressures of the herd. Ultimately, the courage to be boring is the courage to trust your own plan over the collective opinion of millions. It is the understanding that in investing, the most exciting stories often have the worst endings. By choosing a simple, evidence-based, and automated strategy, you are deliberately stepping away from the chaos. You are choosing the architect's blueprint over the wrecking ball's path of destruction. This disciplined and independent approach may not be glamorous, but it is the most reliable and peaceful path toward achieving your long-term goals of financial independence and lasting wealth. On the long journey toward financial mastery, there is one universal truth that every single investor must confront. You will make mistakes. This is not a possibility. It is a certainty. No matter how much you read, how disciplined you become, or how solid your strategy is, there will be moments of misjudgment. You might buy an asset that underperforms for years, sell another too early out of impatience, or get temporarily swept up in a narrative that turns out to be wrong. These errors are an unavoidable part of the learning process. The market is a complex and dynamic system, and perfection is an impossible standard. The goal is not to avoid mistakes entirely, but to learn how to manage them intelligently. Think of these mistakes not as failures, but as tuition fees. They are the price you pay for a real-world financial education, an education far more valuable than anything you could learn from a book alone. Every misstep contains a powerful lesson about the market, and more importantly, about yourself. A poorly timed trade can teach you more about your own emotional triggers and lack of patience than a dozen successful ones. A losing investment, when analyzed correctly, reveals flaws in your research process or an overestimation of your own knowledge. The key is to treat these events not with shame or regret, but with the detached curiosity of a scientist studying data. What went wrong? Why did I make that choice? The difference between an amateur and a master is not that the master makes no mistakes. The difference lies in how they respond to them. The amateur investor often reacts emotionally. They might double down on a losing bet out of ego, trying to prove they were right, or they might become so traumatized by a loss that they swear off investing altogether, retreating to the perceived safety of cash. They let the mistake define their future behavior in a negative way, compounding the initial error. This emotional reaction turns a small financial loss into a catastrophic, long-term strategic failure that can derail their entire journey to financial independence. The master, in contrast, metabolizes the mistake. They accept the loss, extract the lesson, and integrate it into their framework for future decisions. They pay the tuition fee and ensure they get the education they paid for. They refine their system, strengthen their behavioral guardrails, and become a slightly wiser, more resilient investor because of the experience. They understand that the path to mastery is paved with these small, manageable errors. By embracing them as inevitable and educational, they ensure that their mistakes make them stronger, not weaker, turning every setback into a stepping stone toward ultimate success and a more robust, long-term strategy. What does true investing mastery look like? It is not about having a crystal ball or predicting the market's next move. It is not about finding a secret formula that guarantees endless riches without risk. True mastery is much quieter and far more profound. It is the complete and total alignment of your knowledge, your psychology, and your actions. It is a state of being where your well-reasoned, long-term strategy operates on autopilot, completely insulated from the emotional noise of the market and the primal screams of your own internal instincts. It is the peaceful confidence that comes from knowing your system works and having the discipline to let it work. The master's mindset is characterized by a deep and abiding humility. The master knows how much they do not know. They are acutely aware of the role of luck and randomness in short-term outcomes, so they don't get overconfident during winning streaks or despondent during losing ones. They focus relentlessly on their process, their savings rate, their asset allocation, their rebalancing rules, because they know these are the only variables they can truly control. The outcome is left to the market and time. This focus on process over outcome is the hallmark of a true professional in any field, and it is the core of a resilient investing psychology. Furthermore, the master finds simplicity on the far side of complexity. After years of studying intricate financial products and complex economic theories, they often return to simple, elegant solutions. Broad market index funds, consistent contributions, and a long-time horizon. They understand that complexity is often a marketing gimmick that creates the illusion of sophistication while adding little real value. They have the courage to embrace a boring strategy because they have the wisdom to know it is the most effective. Their goal is not intellectual stimulation from their portfolio. Their goal is the successful funding of a rich and meaningful life. Ultimately, achieving this master's mindset is the true end goal of this entire journey. It is about reaching a point where your financial life supports your life goals, rather than being a source of stress and anxiety. It's about building a system so robust and so aligned with your own nature that it requires minimal tinkering. You transition from being an active participant in the daily battle to being the calm overseer of a well-oiled machine. This is the pinnacle of financial literacy and emotional intelligence, a state of quiet competence that allows you to focus on what truly matters, secure in the knowledge that your financial future is being built brick by brick, day by day. We have traveled a long way together on this journey, exploring the unseen architecture of our own minds. We started with the simple story of Arthur, the librarian, who understood a secret that most investors miss. His success was not born from complex formulas or lucky stock picks, but from a profound mastery over his own psychology. He knew that the greatest battle was not with the market, but with himself. This is the central lesson we've unpacked. The quality of your financial life is a direct reflection of the quality of your investing psychology. It is the hidden force that shapes every decision, every outcome, and ultimately, your financial destiny. We learn to see the two brains at war within us, the patient, analytical brain, and the impulsive, primal brain. We saw how the gravity of now constantly tries to pull us away from our long-term goals. The antidote, we discovered, is not to fight our nature, but to build systems that work with it. Automation becomes our most powerful ally, a tool that allows our rational self to protect our future self from emotional whims. By putting our sound, long-term strategy on autopilot, we build a fortress around our financial plan that can withstand the inevitable storms of fear and greed, ensuring our progress continues unabated. We reframed our understanding of key virtues like patience, seeing it not as passive waiting, but as an active, courageous discipline that earns a tangible patience premium. We uncovered our greatest advantage as individual investors: time arbitrage, the ability to use our long-time horizon to outmaneuver a market obsessed with short-term results. We saw how asset allocation is not just a technical exercise, but a profound act of self-knowledge, a mirror of our own temperament. By building behavioral guardrails into our portfolio, we turn our self-awareness into a structural defense against our own worst instincts, creating a truly resilient plan. Finally, we confronted the inevitability of mistakes, learning to see them not as failures, but as tuition fees for our real-world education. The master's mindset, we realized, is not about perfection, but about process, humility, and the quiet confidence to stick with a simple, boring, and effective plan. It is about becoming the architect of your own mind, designing an internal framework so strong and so aligned with your goals that it becomes your single greatest asset. This is the path to moving beyond simple financial literacy and achieving true financial peace and independence. The ultimate goal of this entire process is to reach a state of quiet confidence. It's a place where your finances no longer feel like a source of anxiety or a game to be won, but rather a stable foundation upon which you can build a meaningful life. This journey is not about becoming rich overnight. It is about implementing a system that ensures you build lasting wealth over a lifetime. It is the slow, deliberate, and often silent work of laying one brick perfectly day after day. The principles we have discussed are not quick fixes. They are the core components of a lifelong practice of financial and emotional mastery. This is the lesson that truly changes everything, the one that no one teaches in school. Your behavior is more important than your intellect. Your patience is more valuable than your predictions. Your consistency is more powerful than your complexity. Understanding this allows you to step off the frantic hamster wheel of market news and short-term performance. You can let go of the need to find the next big thing and instead find peace in a strategy that is proven, simple, and tailored specifically to your own psychological makeup. You can finally stop playing the market's game and start playing your own. So, as we conclude, I want you to reflect on your own relationship with money. Think about the architect and the wrecking ball inside you. Think about the siren song of the crowd and your courage to be boring. The real work begins now, in the quiet moments of decision. It happens when you choose to automate your next investment instead of timing the market. It happens when you feel the pull of panic and choose to trust your plan instead. Each of these small victories strengthens your psychological resilience and compounds your wealth. This is the quiet work of a lifetime. It is less about finance and more about a philosophy of life, one built on discipline, self-awareness, and a long-term perspective. By mastering these internal skills, you are not just building a portfolio, you are building a better future for yourself and those you care about. You are creating true freedom. The power to change everything has been inside you all along. Now you have the blueprint to unlock it. The rest of the journey is up to you. And there you have it. 17 powerful investing psychology lessons for wealth creation, yet no one teaches it. If you found value in this, I highly recommend checking out my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay sharp, stay sovereign, and above all, stay moving. See you in the next one, Money Magician.